Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending October the 11th, 2024. I'm Preston Brent. Thanks for tuning in. Well, the theme this week is to the moon, Alice, to the moon. We saw this past week the S&P and the Dow all move into all-time record highs, kind of helped by some upside surprises with earnings as it kicked off with banks this past Friday. We saw both JP Morgan and Wells Fargo all coming in above market expectations, so that helped them out. We did get a solid rise in NVIDIA shares, which helped growth stocks outperform value this week as well. It kind of compensated for a decline in Google following reports that the DOJ is considering asking the federal judge to break up the company. And we also got some of this earnings focus kind of offset some of the disappointing economic data we got for the week. We saw Thursday, we saw upside surprises in headline and core inflation, with core inflation rising year over year of 3.3% versus 3.2% in August. So that's going in the wrong direction. But the markets didn't seem to care this week. Everybody was in a really happy mood. But we also got a surprise jump in weekly jobless claims, 258,000. That's the highest it's been in the past 14 months. So all of these upside surprises in jobless claims and consumer inflation has dropped the likelihood of another 50 basis point rate cut. In fact, I think what we're going to see is probably 25 bips in the November Fed meeting. In fact, there is now a 14% chance that they're not going to cut rates at all in November. We hadn't seen that before. And we did get the meeting minutes from the last Fed policy meeting, and it showed that while only one member officially dissented, several of them had indicated they preferred only a 25 bip rate cut. So now the odds are starting to rise that we may or may not see a rate cut in this November meeting coming up in 3 or 4 weeks or so. We also in Europe, we see in that forecast out of Germany, their economy contracted a lot more than previously thought. 20 basis points this year so far, their economy's contracted, and that's the downward adjustment from a previous estimate of a 30 basis point expansion. That's 50 basis point difference between what they're expecting and where they are right now. We also saw in Germany factory orders dropping about 5.8% year over year in August, and that's a sharper downdraft than the consensus forecast of just a decline of 2%. We did see some positive news out of Germany. Industrial production came up a little bit. And the reason why I'm focusing on Germany, everybody, is that Germany drives the engine in Europe. And I think a lot of this disappointing data coming out of Germany is due to the result of just all the hard times going on in China right now, because they're a big buyer of German exports. Meanwhile, we did see across the Eurozone, the ECB, they reiterated their expectations that inflation is going to slow towards their target of 2% by year end. But they're still taking it slow and easy, one meeting at a time, right? But the comments that came out of the ECB officials kind of appeared to align with the market's view that the pace of their policy easing could quicken if inflation slows a little bit more, all right? And meanwhile, over in Great Britain, their economy rebounded in August, expanding 20 basis points in the month of August year over year after stagnating the previous 2 months. So that's a good thing out of there. But Europe is just, having a hard time of it right now. The other thing is, let me just move over here. Let me move a little bit over here like this. And let me just give you a little bit of a view here of, and you could see, before I continue on, you can see where we are with the U.S. I mean, strong performance for the week. Year to date, everybody's in the green. The best performing sector for the week was technology, worst was utilities. But utilities is still leading sector performance as we go into the second half of October of this year, all right? You can see the PE ratio is very rich. The forward PE is at 23.75, which is only just slightly under 4% less than the trailing. But I'll tell you, to me, it's too rich. The earnings yield for the S&P is at a little over 4.5%. But look at the current VIX. It's up to 20.46. Last week it was at 19.21. So it's up a pretty good little bit for the week. And for several weeks in a row, even though the markets are going up. And as I tell all my members, when the VIX is moving higher, in correlation with the markets moving higher, generally volatility usually wins out 70% of the time, which means we should expect a little bit of a pullback here going into the US elections, which are coming up in about 3 weeks. And I think a lot of companies, we're going to see a lot of data where companies are pausing a lot of their capital expenditures until after the election to just know what kind of rate and policy environment the U.S. is going to be facing going into 2025. So a lot of things are on hold for now. Okay. But that's a little bit about what I'm seeing here. And then, of course, as I was just saying, over in Europe, you could see kind of flat, a little bit in the green on some. The FTSE's back in the red for the week. But year to date, everybody's in the green. The CAC 40 moved back into the green. Again, that's the French index, 46 basis points in the green. But if we look over in the Asian markets, you see the Nikkei had a good week. Their real inflation adjusted wages fell 60 basis points year over year in August. And we did see household spending or consumer spending fall 1.9% year over year this past month also. But that was better than the consensus forecast of a 2.6% decline. And what's kind of calming the markets a little bit, latest comments out of the Bank of Japan, where policymakers reaffirmed that the central bank stance remains unchanged after the newly elected government officials take their offices in Japan. So that kind of calmed the markets just a little bit. Meanwhile, if we go over to China, you can see solidly in the red for the week, still in the green year to date out of the big stimulus move. Although Chinese equities fell, it was a holiday shortened week for them this week. But equities still fell a pretty good little bit as optimism about Beijing's stimulus measures are starting to pull back a little bit because that's not going to fix their overall longer term problem. And the country's economic planning agency also announced this past week at a press conference that China is going to speed up counter-cyclical measures to support growth. So there's a lot of meaning behind that. But the PBOC, the People's Bank of China, launched a multi-billion-dollar swap facility, which is just layman's terms for putting more liquidity into institutional investors and others to buy stocks. Now they want to start prepping up the stock market or propping up the stock market. Giza reports coming out of Bloomberg. Meanwhile, spending by Chinese consumers over the long holiday that ended this past Monday, as I said, lagged pre-pandemic levels. So China is still having problems. They're going to continue to have problems until they get all of this real estate debacle sorted out. And I told our members last week they're over, I think it was 90 million housing units that are empty in China right now. 90 million. It'll house 150 million Chinese. They're like cities to nowhere. And they built all these probably to keep people gainfully employed, mostly the male population there. But I think all of this stuff is slowly blowing up. And China's going to have a hard time this year, and I think they're going to have a hard time next year. We're going to see those big bounces in key ETFs that track China. But you got to be very careful with these things because there's a lot of volatility associated with them. I'm going to switch the screen over, and let me take you over to the E-mini S&P 500 futures. Now, let me just swing over here real quick. Let's see, right here we go, right here. So I'm going to take you over to the S&P 500 E-mini futures, and what you're going to see on the screen is for the S&P futures anyway, new all-time highs that were made this week. You can see here we're hitting, from a timing standpoint, right on my target, all right, for an Elliott Wave 3. I'm looking for a pullback here. You can see this gap here that was made way back on September the 12th and then the 13th. And a lot of this gap had to do with the shifting from the Q3 to Q4 futures contract series. But you can see here the estimated pullback shortened and a little bit out in time here. And even in the midpoint of this estimated pullback, it's not a lot. I mean, if I were to just kind of come in and just give it a little bit of an idea, about 3.82%. And as I told my members, I see anywhere from a 3 to a 6% pullback, even though we had a really strong week. You could see where we were inside this little tight breakout area right here, if I were to just kind of highlight it so that you guys can see, I highlighted it for our members just like this, right? So we spent a lot of time breaking in, and now we sat here, and now we're starting to break out right here, okay? So the breakout is usually measured between the distance of the channel itself, or the box that you're in, right? The range that you're in. And you're looking at about 75-point range right here. So that would suggest up to about 58, 78, just slightly under 5,900 as we go into the election. Now, I will remind everybody that October tends to be a very ugly month as far as trading goes. We're well north of the 50 EMA, eons away, light years away from the 200 EMA. But if you look at the MACD, there is no bearish divergence. That does suggest, and we got a cross in the MACD well above the zero line. So that does suggest that the markets are coming in strong. But if you look at volume, this purple line is a 5 EMA, and the blue line is a 20 EMA. And you can see the volume has been very low. So we're really, and you can see the volume here on this sell-off. This was back in the late July, August timeframe, the sell-off, and then this big move up here, just not as much volume coming in, right? And let me just put it on a weekly chart here, kind of zooming in just a little bit more. You can see here that volume took off when we had that big sell-off, right? I mean, this big sell-off right here, volume picked up, and now this big move up, volume peaked right here on the week of August the 5th. That was that big move lower. You can see that handlebar here is a hammer, which suggests bullish action after the hammer. But then as we've moved up here, you can see how volume is just completely dropped off, and ending this week much lower in volume. So that does tell me that as we move higher, volume is getting harder and harder to come by. So I don't see a lot of new buyers stepping in right now leading up to the election. We could see some movement higher just because of momentum. You can see October the 11th, all-time highs, up 21.93% intraday. And we're near that now. But you can see the pullback points I've got here estimated down to 57.63, down to 56.27, right? Which would be a normal pullback in my mind to give the markets a little bit of room to breathe before we make another run again. If we come in here, and let me just get this off the screen here, and let's come back up and look at here we go right here, the equal weight index. You can see the equal weight is also made new highs in this year, up 14.05%. Now, you can see here a little bit of a divergence, but not much in this move higher. So that tells me we are still seeing rotation coming out of tech, especially the Mag 7, and going into other stocks. So that's a good thing. As breadth starts to expand, it gives the market a much more firm footing. And that's what I want to see. So we are seeing the equal weight SPX moving up nicely. And then, of course, if we look at the Dow futures, the other index that made new all-time highs this week, you could see it was up here at 13.73, right? And there was no divergence from this peak to this peak. And if we take a look at volume, you can see volume here as we moved up also dropped off dramatically, right? So we've got to watch this very closely to just see. But to me, we're so far ahead of the 50 and the 200 EMA that in my mind, it's just the markets, even though we want to be bullish, I am a buy the dip type of scenario right now. You want to set tighter stops and don't be afraid to go bullish. And any dip is more than likely going to be bought. But I do believe, I do see some weakening in the markets as we come up over the next 3 or 4 weeks to the election here in the United States. And of course, if we come in here and look at the FANG index, right? The FANG index, the last all-time high we made in the FANG index was July the 10th. Although we had this big move lower on August the 5th, you can see we're moving up, but we're nowhere near as close. And you can see this tight range that we're in right here in this little box, where money is coming out of these mega cap tech and rotating into value and mid cap growth and those types of things. So it's always a good thing. Now, a lot of people thought when when interest rates were coming down that the Russell would take off, okay, because small cap loves falling interest rates. But we're still, the last all-time high was back in July, right? So the Russell, there's still a lot of companies in the Russell 2000 that are just underperforming, right? So I would take small cap growth could be an interesting play on the ETF, but um, um, right now I would just, and it's holding the 50 EMA here, right? If it breaks down below the 50 EMA, I think you're going to see the Russell come back down to the 200, which is just slightly above the closing price of last year. Okay. If we come down and we look at volatility, because I talked about volatility, it was down on Friday, but it's up for the week. If you look at it, we're still um, pulling back just a little bit, but that's a bull flag in the VIX. And this is forecasting a higher VIX as we go through the next 3 weeks, all right? And to me, it would not surprise me because we've seen the VIX come up off the lows since the end of September going into October. Even though we've been making new all-time highs, the VIX is running up too. Now, part of that is due to the coming U.S. election. Some of it is geopolitical with the Mideast tensions with Israel, Hezbollah, Hamas, and Iran. We're getting a lot of that out there. So we have to be very careful coming into this election. I think it's just the volatility is going to stay elevated until we see who is going to win this election. And my bet, I don't think we're going to know even right after the election unless it's a landslide. And they'll probably figure out a way to delay it a week or two until they validate all the ballots because it's going to be a mess. Now, if we look at treasuries, this has also caused consternation in the equity markets. Look at the bond market. Now, if I break out just a little bit here, you can see this upslope and trend line. The bonds broke it, all right? And this suggests bonds are going lower. Now, if bonds are going lower, remember what I said, long-term rates are falling. 10-year treasuries are falling, the rates now. The rates are coming down. And the rates are going up. The actual treasury is going down. So when bonds are going down like this, interest rates on the long term and the short end 10-year treasury note are also going up. In fact, U.S. Treasury hit the highest intraday level since this summer at 4.12. And this is the 30-year. And this break here suggests the bond markets don't necessarily believe that the Feds are going to be very aggressive in cutting the rates, right? Remember when the bonds were moving up really strong like this, everybody was talking about just how aggressive the Feds are in cutting rates. And the markets were betting on 6 rate cuts this year, 1.5% rate cut, 1.5% interest rate cut. That was the forecast earlier this year. Bond markets are going up, interest rates are going down. And after some of these recent inflation reports, and then Boom Powell coming out and saying what he's talking about, and right now there's even as I said, a little over 14% chance they're not going to cut rates at all in November. Well, that's going to drive interest rates higher and the notes and the bonds themselves lower. And that's what we're getting, right? And then if we look at the 10-year, it's going to look the same thing. 10-year treasury, here we go. In fact, the 10-year treasury's moved into the red for the year, which has driven the rates up, okay? So the bond market generally is a smarter, more sophisticated market than the equity market because most of the institutions are playing the bond market. Very few retail traders do get in there, but it's usually run by central banks and institutional investors, sovereign wealth funds, and things like that with hundreds of billions of dollars to spend. And that's what's happening here. And the bond market is essentially saying the Feds are going to keep the interest rates higher longer than the markets expect. Now, there's going to be a moment where the equity markets start to realize that, and it's going to reduce some of the PE ratios through higher multiples and valuations. But we'll see that, and we'll get the forward forecast of all the earnings because they're kicking off The markets officially kicked off this Friday with JP Morgan and Wells Fargo. But then this week, we got a ton of bank stocks coming out. So we're going to get a lot more information on that. And of course, if we look at the dollar, you can see the dollar. Obviously, the dollar is a lot stronger, right? With the rates not coming down as fast compared to other currencies, well, that's going to goose the dollar up. I think the dollar is going to run into trouble up here a little bit, and it will eventually roll over. But for now, that's what it is. And obviously, the euro is going to be just the opposite. You're going to want to be up by the dip, but the dip is a pretty deep one. It's probably going to find support around this area here. But if Europe gets even worse, and just, many people think Europe's already in a recession, but that's going to crater the euro, and it's going to strengthen the dollar, just by nature of the euro being cratered, because the euro is almost 58% of the dollar index. So that's a little bit about what I'm seeing there. And of course, the Japanese yen, you can see over here with the yen, it's coming down. The big fear was with the new government coming in, will they be as aggressive in hiking the rates? And as I just told you earlier, with the latest comments out of the BOJ, they are reaffirmed that the central bank's policy stance remains unchanged, which is basically they're not going to do any rate cuts in the near term. I mean, rate hikes, sorry. So they're keeping stimulus out there. So that's going to keep a little bit of downward pressure on there. We got in down in this area here, made some really good money on the yen. It was a good trade. In this area here, I'm just, you could get some of the members that took that trade got out for profits. And we're just waiting for another pickup point here with the yen, right? It will happen, but just not right now. And then, of course, if we look at metals, gold is going up for a number of reasons. You can see here it's going to probably come up and test its highs here. You can see there is no divergence in this high point right here. Gold's going up primarily because of U.S. debt and the issues that the U.S. government is going to be facing shortly with the debt as a percentage of GDP. Our deficit's almost, 1.9 trillion. That's got to be financed in the auction market every month. We got to raise that money to pay our debt, and that's going to just continue to drive gold higher. And with inflation coming down and interest rates holding steady, too, coming down, that's also going to help make it less costly to hold gold. And you're seeing that as a hedge, and also geopolitical as well. So that's kind of what's got gold going right now. Over 1,000 tons of gold were bought in 22, and 1,000 tons of gold were bought in 23 by China and India and a few others. So they're adding to their collection. So gold is in an upward stance. As I said all along, you want to be a buyer of dips in the gold market. And silver caught up to gold. If you look at this, it made new highs here on October the 4th. Silver was down here while gold was near all-time highs. And I told our members, just do a pair trade where you go long silver and short gold. Those trades worked out very well for those that took the trade. And in our option masters, we're setting up an option masters on how to better do pair trades. They're really great trades, and you're trading not one asset class against another. You're basically trading that they go in a correlation, and when they get too far apart, they will snap back together. And understanding how to do that trade is a really good trade. But anyway, that's where I'm looking at metals. And of course, if we look at copper right here, copper moved up on the stimulus with China. Now it's pulling back. Longer term, you want to be bullish copper. Short term, they're going to go where China goes, right? And we're finding some support down in this area right here. Of course, with oil, you got the Middle East. That's what moved oil up, right, like this. You can see right here, we're back in the green. We are having trouble holding the 200 EMA. There's a lot of fear premium in the cost of barrel per oil, right? And a lot of this moved up here. We hit my target down here. We did another test. And it was a beautiful bullish divergence, a long signal back over here on October the 1st to get long oil. You can also use oil as a little bit of a hedge if we do have a serious confrontation and a kinetic war over in the Middle East. If Iran gets involved, it'll spread very quickly to other Middle Eastern countries. And being long oil would be a good thing to do, all right, as a hedge. So that's a little bit about what I see in the oil market. Nat gas, I'm waiting for it to come down a bit. You could see how I got a little bit too high up here. What I would like to see is This is an Elliott Wave 3. It does suggest it's going to finalize an Elliott Wave 5 up here. If we get that, that will be like a Christmas tree for me, because then we're going to short it. Over here, I was suggesting you go long nat gas. Up here. If it gets up a little bit higher, we're going to want to short it. That's how you're going to want to play it. All right, everybody, that's a really quick roundup for this weekend. Members, I'll see you Sunday evening for our weekly market watch. Otherwise, have a great weekend, everybody. Ciao.